Welcome back to the Retire Young radio show. I am your host, Joshua David, having a great time in studio with my great friend, my great pal, the smart guy of this operation, Mr. Al Connickson. Also, don't forget to subscribe to the Retire Young podcast on Apple Podcast, iHeartRadio, and Spotify. If you're just tuning in, Al was shedding some light on how these markets really work. It's based off of supply and demand and institutional activity. It's the big money, the smart money that is creating these financial moves within the stock market. But here's the thing, they're always creating income as well. And he talked about how the smart money typically trades against the public. So that's why it's important to have a strategy that's designed to trade like the smart money, not against them. And that's how I want to get into this next segment, Al, is talk more about the smart money, how they are creating income, and having a proper strategy that's designed to do the same things that they do as well.
Well, you know, in that first segment, Josh, I mentioned that a couple of things that are really important is one, to take a trade or make an investment at a point where you have the highest probability of it succeeding. And then also you want to have a good profit potential. Those two things always happen at or near the turn in price. And so it really becomes key to be able to identify where that is going to happen. We do that by teaching our students how to read a price chart and identifying the price chart where that activity takes place. That's where the institutions come in, because they are trading with high amounts of money. They can actually make the price change. If the price is going down in something and institutional buyers come in with their big amounts of money, they can turn that price movement from down to up. And then we want to be able to identify how far it's going to go, because they'll typically do that trade, take an entry position, open a position where they feel there's good value, and they will exit where they feel that that particular asset has become overvalued. So we help our students to identify where those 2 points are on a price chart that's in a demand zone where buy orders are residing and a supply zone where sell orders are residing. Now, you mentioned the word income, and a lot of the people that are listening, that might be one of the goals they have, is to try to generate additional income. So I guess maybe the question is, why do you need income now? Do you need extra income?
Well, what is that? What's like the definition of that, though? Because a lot of our listeners may not really know what you were really talking about.
Sure. In the financial markets, that's the cash that's derived from an investment, minus any commissions that might be or any fees that might be involved. And if it's needed, if somebody needs that additional income or that additional cash now, when is it needed? If it's short term, it means short term. That doesn't mean 10 years or 20 years or 30 years. That's not going to come from the typical Wall Street portfolio, which is a buy and hold. And unfortunately, for a lot of people, that becomes buy and forget. They will have somebody help them put together a portfolio, or maybe they do it on their own, and then they're told just to hold on to it, sit on it for maybe 10 or 20 or 30 years. Don't worry about these drawdowns or these corrections. But for short-term needs, you need something that you can get into and out of on a short-term basis. Maybe it's daily, maybe it's weekly or monthly. That's not that long-term buy and hold type of an investment. Some of the short-term assets that are available to trade are the things that we talk about every week: the futures market, the foreign exchange market, the options market. Those are assets that the institutions, the big traders, the smart money, those are things that they're using on a regular basis. Ironic that that's not the type of thing that they put their clients into. Why would they put their clients into a buy and hold strategy with mutual funds or stock, but they trade futures, forex, and options? Well, it's because they're looking for those short-term hits. And if you have a client base of maybe 300, 200, 300, 400 clients, as a financial advisor, you just do not have the time to manage that many portfolios on a short-term basis. So that's why people are put into a mutual fund or an exchange-traded fund grouping, or maybe just a grouping of stock. One of the reasons that mutual funds are probably the top choice with financial advisors is they're passing off the management to somebody else, and they're collecting fees even though they have kind of a hands-off approach. Great business model for them.
Major fees, yeah.
But, why do you want to do what the institutions are doing? Because, number one, they know the right assets to use to generate that shorter-term income. And by the way, it doesn't mean just in an up market. The smart money knows how to do this when the market's going up and when the market's going down. And to be honest with you, also when the market is flat, when it's going sideways. And there are strategies that can be used. in up markets, down markets, sideways markets for that shorter term income goal. But the institutions also, in addition to knowing how to do those things, also know how to control the risk. Capital preservation is extremely important for them.
You're correct. I mean, just to clarify a couple things there too, you were mentioning like shorter term in trading and investing styles. And that doesn't mean, clicking the button as fast as you can. You have to have a proper strategy that's designed to generate in a shorter term horizon. And also, you were mentioning supply and demand zones, areas of interest, we'll call it. A lot of people think that you have to pick the exact price of where to get in and where to get out. You have to have proper, zones of where you want to get in, where there's an area of interest. That way you don't have to be exactly right every time, but you want to put the probabilities and the odds in your favor. I've heard, I had a couple conversations with some friends this past weekend, and they were talking about how fast the stock market's moving, how fast it's going up, how fast it's going down certain days. And they're afraid. They're afraid of getting in the markets because they just don't know how to get in because it is so fast.
Right.
Now, think about this. If you had an asset that is slower moving, wouldn't that be more comfortable to get into? Now, I want you to explain how great the Forex market is. Basically, that's an exchange rate, and it facilitates international trade and investment.
Right.
And what's nice about this currency market, the Forex market, is currency, changing price. That's a process. It takes time. Basically, if they change those prices too fast, that'll have a negative effect on companies
that trade internationally.
Yeah, that trade internationally, that do business with these countries. So explain how great the Forex market is, what it is, how us as investors, the public, can utilize it just like the institutions do.
Yeah, it's got a couple of great benefits to it. It's primarily called the Forex market. It's the foreign exchange market. That's where you are looking really at the difference in exchange rates between two different countries, two different currencies. And as Josh mentioned, that can take time to take place. Governments typically move on a slower basis, and their movement actually has a pretty big impact on their currencies. So you trade that as a pair. The great thing about it is it trades 24 hours a day, so you can choose when you want to be active. The markets are open around the world 24 hours a day, so you can participate globally pretty much at any time of the day or night when you feel like it, when it's best for you. It also has great leverage. The Forex market trades with essentially a 50-to-1 leverage, and that's where the big institutions are looking at making a lot of their profits is from that kind of leverage. That's pretty fantastic when you think about it. A relatively small account can control a much larger investment. And brokers will allow us to do that as investors. We can trade that market, and with the leverage, with the margin account, it allows people to participate that might not otherwise have been able to participate in an asset that has maybe a higher value. So not only do the institutions and the big banks trade at the Forex market, but a lot of investors, a lot of the public do. And I think that's your go-to investment, Josh?
That's one of the best. I mean, I think it's the best one out there because it moves slow.
Correct.
And you can be more comfortable and confident with your positions. It's a lot easier to do that because it's not moving so fast like the stock market is.
Yeah, and it allows you to participate not only just in the income part, but also for your retirement accounts too. And typically there is a difference in the way you invest for income. You trade for income and you invest for your long-term portfolios. But Forex is one of those assets that can be used for both, as can options. Options can be used for short-term trading needs, more intermediate, and then also long-term. And options in your retirement accounts, and we'll talk about that in the next segment, can be used to kind of boost the value and the returns on your retirement accounts.
So explain, we got through the Forex market, explain what the futures market is and why someone might want to use that. That's also a little slower if you think about it.
Sure. Well,
certain contracts.
Yeah, certain contracts are. And what you mentioned, their contracts, what we're talking about is the different components of the futures market. Futures also trades basically 24 hours a day. It's a leveraged asset, and the different contract components have different amounts of leverage. It could be 20-to-1, 50-to-1, 100-to-1. But the contracts can be placed on the major stock markets, the Dow, the NASDAQ, the S&P 500, Russell, some foreign markets. But you can also do contracts on commodities. and you can do contracts on precious metals, gold, silver, oil, currencies, interest rates, a number of different things. And one of the great things about that futures market, if you're going to trade just one market, is that there's great diversity there. So if you talk about true diversification, let's look at some of the commodities. Corn or sugar or soybeans really have nothing to do with what's happening in the S&P 500. So you can be involved in the stock markets and also in another type of market, maybe going long in one and short in another. But there's true diversification, which is hard to get if you're just investing in the stock market or mutual funds.
Let me add something there, because we have some listeners that are probably thinking, well, heck, I don't know anything about sugar. I don't know anything about lean hogs. I don't know anything about lumber. Do you really need to know about what those are? I mean, it's a good odds enhancer.
Sure.
But remember, earlier you talked about basing your decisions off a price chart.
Right. The point is, with the price chart, you're identifying where price is going to turn. And also you're identifying how far it will go. That's the profit potential. At some point in time, you could be able to look at a chart, not even know what it is a chart of. It could be sugar. It could be corn. It could be the S&P 500. It could be Apple. Doesn't make any difference. If your goal or your reason to be investing is to have a profit potential there, then you just look at a chart. You can base a trade or investment decision off of a chart without knowing what the asset is. You're just looking at where price is going to turn and how far it's going to go. That's how we can help simplify these things, so you don't have to go into detail on all the fundamentals of a company or a product. Fundamentals for short-term trading, it really are of no value or very limited value. That's more of a long-term requirement and necessity, is to look at the fundamentals if you're putting together a long-term retirement portfolio or a wealth portfolio.
Yeah, and think about that. If you have more comfort in your investing decisions with some of these slower markets like the Forex market, it just brings you more confidence. And think about this as well. If you do like the stock market, that's fantastic. You can still participate in the futures market with the major stocks, the Dow, the NASDAQ, the S&P 500. So you still have that comfort of, I guess, what most people say, of what they know, because they know the only reason they know about it is because they talk about it on TV, because they want the public to only invest in stock. There's a lot more opportunities out there, and they're not new. They're just different. Coming up next, I want to get into more retirement. You mentioned a couple things about retirement earlier, the options market, how great that is with that, even the Forex market, because they're slower moving, slower paced. It brings more comfort for people. So I want to get into retirement techniques and strategies that the smart money uses that are also available to us. We'll be right back.